Hey there, Roger Whitney here. Welcome to the Retirement Answer Man Show. I'm excited you're here. This is the show dedicated to helping you not just survive retirement, but have the confidence to really rock retirement. Now, last week or the week before, we had over 100 people gather in Fort Worth, Texas for what we call the Retirement Rodeo Roundup. Essentially, a conference for people on the journey or transitioning into retirement to learn from retirement experts, but more importantly, to learn from each other. And here's two observations I had from that weekend in Fort Worth. One was the energy of the attendees was pretty amazing. It's easy to have a successful event when people are so motivated and excited about what we're talking about. So that's number one. Number two is how much they wanted to learn from each other. Everybody there was very interested in connecting with people that maybe were doing something that they were doing or a little bit ahead of them on the journey. That was really impressive. That really surprised me. Now I'll throw in a third here on a topic standpoint, because on Sunday we had breakouts where we had sessions where people could select the topic that they wanted to talk about. And one of the hottest topics was overcoming frugality. Overcoming frugality. Now it really surprised me, but in a sense it didn't. Generally, people that are at a conference like this, and also, by the way, the Rock Retirement Club hosted the conference for its members. We're going to have a live event to tell you more about the Rock Retirement Club, which gives you the community, obviously, but also a master class and tools to create your plan. You can learn more of that about that at livewithroger.com. I think we're doing that on November 16th. We're just going to have a virtual open house. So livewithroger.com if you want to learn about that. But people that are going to be a member of the club or even watch something like this generally are really, really good savers. Probably like you've worked decades in your career or in your business, and you've done a good job of delaying gratification and investing in your 401ks and IRAs and other investment assets, giving those monies time. So now you're here within 5 years, either side of retirement. You're seeing the consequence of all those little decisions to be a little bit frugal and to delay gratification, right? Makes sense. That's why you potentially have all these options of retiring early or traveling in retirement. So when you actually make the transition to retirement, it doesn't seem reasonable that you're actually going to stop saving and start spending. That's a big mental shift that is very uncomfortable, because if you've been a great saver, you probably have built that muscle to see the money go into your accounts, update your net worth statement, see those monies grow over time. Well, imagine not saving and getting that rush and seeing your account stay stagnant or even go down if you're spending money. That's a bigger mental shift. So I guess from that perspective, having to overcome some frugality when you're in the season of harvesting makes a lot of sense. So some thoughts there. Maybe we'll explore that more on the show. Maybe it'll be a series for 2022. But today I want to answer just a few of the questions from listeners of the Retirement Answer Man podcast. You can find that in iTunes if you're watching this via video. And if you have a question for the show, you can go to that's where the open house is. You can go to rogerwhitney.com/ask Roger. And if you have a retirement question, you can ask it there and we'll try to answer it here on the show. So our first question comes from D about balance funds. And I'm going to read this question. If some of my portfolio includes balance funds, how do you calculate how much to add to your asset allocations for stocks, bonds, and cash, etc.? So D, first let me explain to everybody, when she or he, I'm not sure, mentions a balanced fund, what are we talking about? Well, a mutual fund is a wrapper of a portfolio, right? And a balanced fund is a portfolio that has a mix of different asset classes. It could have bonds, it could have stocks, it could have some real estate, etc., all in one individual fund. So it's trying to give you a instant allocation of sorts. And that can be very convenient. And what Dee's referring to, well, when I'm looking at my overall allocation and all these different accounts that I have, how do I account for this one sort of all-in-one investment that I have? And that's a great question. So, Dee, the way I would suggest that you approach it is, one, you can go to morningstar.com and just type in the symbol of the fund. And you can do this probably on any financial website like Google Finance or Yahoo Finance, etc. And go to portfolio, and it will show you the allocation of the portfolio under portfolio. It'll say this is how much approximately it has in stocks and bonds and cash, given the last update from the fund family, because generally they're going to update that information. I believe it's quarterly when they issue their updated numbers. They'll give you some dynamics of the portfolio. So one way that you could do this, D, is to say you have XYZ balance fund and there's $100,000 in it. You go look it up on Yahoo Finance or Google, and it says it's 40% stocks and 60% bonds. Well, then you could put that into your spreadsheet or however you track your aggregate asset allocation, and that should suffice. Now, the thing is with balanced funds is they're going to move around. They won't stay at a hard allocation, say 40% stocks and 60% bonds. They may move around depending how active the manager is in managing the fund. That's okay. I think if you look at it quarterly and enter it in there, that's going to be good enough. Now, when we think of balanced funds, those are target date retirement funds or target allocation funds. My preference are target allocation funds, which are funds that have a strict asset allocation and they're not trying to time markets in any way. But that's how I would go about figuring that out, D. I wouldn't worry about always getting too precise unless it's a substantial amount of your assets. I think it's a big fallacy in planning that more precision is going to somehow improve your plan or actually get you more accuracy. I think that can be probably too much to do. So don't worry too much about that. Now, our next question comes from Jenny, and it's an audio question on Social Security. So let me play this question from Jenny. Here we go.
Hi, Roger. I'd like to talk about claiming Social Security and how that can work with your tax strategy. I expect to have really large RMDs in retirement, and I was thinking it might be better to claim at 62 and have smaller amounts, but over a longer period of time so that I can have more flexibility as far as what my income is. What are your thoughts on this? I thought this would be a good time to ask this question, given the monthly theme of taxes. Thanks. Bye.
Hey, Jenny. Great question. This is regards to our tax management and retirement series that we just finished up last month. When you're thinking about when to claim Social Security along with tax management, it's easy to think in vignettes where we grab one idea and then just run with that thread rather than thinking in an organized way. And I think that's one of the key things we need to do, or you need to do in retirement planning, is to focus on organizing decision-making. So when these little vignettes come about, that you have a way of putting them into a complete story so you can make a better decision. So Jenny, here's what I would suggest how you would approach it and some things that you should think about. Number one is, so Social Security, if you take it at age 62, it won't be taxed, but it can be lowered based on the income that you have early in retirement. So if you're not 62 yet, you don't sound like it, and you're asking the question. So if you were to be earning income from 62 to your full retirement age, and that income's over whatever the maximum is for Social Security, they're actually going to start lowering your Social Security payment. And now that money doesn't go away permanently. What happens is at full retirement age, they'll recalculate your benefit and pay you back the amount that they withheld. I think it's over 15 years, but I can't recall. And so there's that. And then once you reach full retirement age, your Social Security becomes taxable if you earn over certain amounts. And I have the sheet here for 2021. If you're single, 85% of your Social Security is going to be taxable if you earn over $34,000. And if you're married, over $44,000. So it's pretty simple for your Social Security to become taxable. So that's number one. So what do we do with that? Well, if you're prior to 62 and you're retiring and you know you're going to have substantial RMDs, like you've said, one thing you want to do is map out, okay, from the day that I retire, you map it out, say 15 years at least. What are my income sources going to be? From, maybe a pension, Social Security if you turn it on, part-time work, etc. And then what are my expenses going to be? And what's the difference, the difference between my income and my spending? And if there's a deficit, that's what you're going to have to pull from your assets, right? You'll pull those from IRA assets or Roth assets or after-tax assets. This is really important to have that basic cash flow timeline spelled out, Jenny, to make this decision. Because if you leave full-time work, you may have a window from 62 up until RMDs, required minimum distributions, where you have very low income. If you're going to have substantial RMDs, I'm going to guess you've been in a high income category for a long period of time. So when you're making this Social Security decision, you're going to have to calculate, do I want to take advantage of my retirement age up until, say, age 72, when I'm in the low income tax bracket, to potentially draw from your IRA assets early? Because drawing from your IRA assets might help you fill up the tax brackets, like we talked about last month with Andy, and conversely, lower your required minimum distributions. And the way you start that is you build out this timeline and you create a plan of record. And I would suggest that your plan of record is that you turn on your Social Security at full retirement age, and that you plan on spending after-tax assets and then IRA assets, and forecast what your required minimum distribution might be at age 72 if you do the normal way of planning. And once you have that calculated, you can get an idea of what your projected RMD is, and it sounds like it's going to be substantial. And then you can create a carbon copy of that and say, well, what happens if I delay Social Security, maybe to 70, and start drawing from my IRA assets early? What tax, do I do that up to the top of the 12% bracket or the top of the 22% tax bracket? And then compare how those look. Because RMDs aren't necessarily a bad thing if you're going to end up having to take that amount out already. But I think you can compare them side to side to see which one puts you in a better position for your future self. Another option would be, if you want to spend your after-tax assets, Jenny, is to do Roth conversions by filling up the tax brackets. I'm a little wary of taking Social Security at 62, especially if you don't need the money, unless you know you have very short longevity because of some genetic or health issue. I would look at Social Security as longevity insurance and try to maximize that benefit by delaying as long as possible. It's not a matter of where the break-even point is. I just think there's a huge opportunity during the years when your income is much lower when you leave work. But I think if you can create that spreadsheet, and then you can create the traditional after-tax, and then create carbon copies and run different scenarios, I think there's an opportunity where you could fill up some tax brackets. So I'm not a huge fan of taking it early if you can avoid it. All right. Our next question comes from Joe. She says, thank you so much for all you do. I've learned a great deal. You recently discussed filling up your tax brackets. So another tax bracket question. My question is, in retirement, I will be receiving a pension, which is taxable. I have taxable brokerage accounts, Roths and 401ks. Which one should I prioritize to fill up the tax bracket bucket? One of my taxable brokerage accounts gives me large dividends each year of about $10,000. So, Joe, you're going to follow the same approach in that you're going to build out this plan of record. We need to do a topic. We need to do something on that. A plan of record is important, that first iteration of what the plan is, so you can compare. So you want to map out your income and your expenses for at least the first 5 years, and then look at the opportunity of how much you can fill up a tax bracket bucket. And so for those of you that might be new to the show, what we're talking about is, let's say I'm looking at some numbers here. Let's say you are married and you have $50,000 in income. So you're in the 12% tax bracket for 2021 rules. And the top of the 12% bracket is $81,000, plus you get your standard deduction. So if you earn $50,000 and the top of the 12% bracket is $81,000, for simplicity's sake, we have about $31,000 that you could earn where you're only going to pay 12% before you go up to the next bracket. So that's what we're talking about. So for you, Joe, I would, one, decide, are you going to use these dividends to help fund your life, or are you going to reinvest them, probably as you typically have? And then look at what assets. Well, let me think through this here. I'm looking at it. You're going to prioritize taking from IRA assets to fill up your tax bracket buckets, your IRA or your 401k, because Roth assets aren't going to help you there. So those are the ones that you're going to want to focus on if you plan on taking money out to tax optimize, and you could take it out to spend, or you could do a Roth conversion. And those would be the two ways that I would think about it. Now, our next question, surprise, surprise, is another one about tax brackets. And this is from Nicole. Nicole says, hi, I listened to your podcast with Andy where you guys were saying it's beneficial to take out more from your retirement vehicle, at least to fill up a lower tax bracket. My question is, if you don't need the money, what do you do with it? Keep it in cash, put it in a brokerage account, etc. That's a great question, Andy. And that's part of this tax management part of it. We don't think about this stuff if we don't need the money, right? Because you have after-tax assets. So your options are, one, take out the amount to fill up the bracket that you're comfortable with and spend it as part of your spending plan. You could invest it in after-tax assets. They have some clients that do that. Or you could, and this may be the best opportunity, convert that to a Roth and have that grow tax-free for the rest of your life. So those are going to be your three options. Now, if you do the Roth conversion, you're going to have some tax that I would preferably have you pay from your after-tax assets, assuming it doesn't drain your liquidity. But those are your three options. You can spend it, you can invest it in after-tax assets, or do Roth conversions. So I think those are three options, with the last one probably being the best. Scott just had a comment on Tanya Nichols from Align Financial. Tanya said, Scott says, I really enjoyed Tanya last month. Now he's referring to, this is before we've done video, to a whole series we did on women in retirement. And Tanya Nichols is a certified financial planner, Align Financial out of Duluth, Minnesota, and she's wicked smart. And he said that she really enjoyed Tanya. I could tell she became more comfortable as the month went on, and she had some good value. So awesome. Thanks, Scott. I will make sure that Tanya knows, and no doubt we're going to see her on the YouTube version of the show, but also on the show again. And with that, we're going to wrap it up. I want to thank you so much for hanging out with me today. So my challenge to you as we're heading through the end of the year is to calculate what your expected income is going to be for 2021, because you have a little bit of time here to look for some potential risks, Perhaps you're a year and a half away from, or 2 years away from Medicare, and IRMA is a consideration where you might have a surcharge on your Medicare. So maybe you can do some planning there. Or perhaps you have some opportunities to do a Roth conversion or to manage for Affordable Care Act subsidies. But right now is a great time to estimate your year-end income and look for things that might help you improve your plan and rock retirement. And with that, I hope you have a great day.